All right, welcome back, folks. I'm Tony Lopes with Dirty Boots Capital, and today we have the amazing Chris PreFontaine here on the show. He is known as the smart real estate coach. He does coaching. I do coaching. This is not, as I see, a competitive sport. At the end of the day, he and I, as you folks know, you listeners, you audience out there, you know, we just want to help people achieve more in their life, whatever that is. Health, wealth, real estate, freedom. We don't care. We just want you to achieve more. So Chris is here with me today to share a little different perspective of what he does. He does things differently than I do. And so we just try to collaborate and, again, just try to help people. So, Chris, welcome to the show.
Yeah, thanks for having me, Tony. Hopefully we'll impart some nuggets as we chat.
Yeah, I think so. So, Chris is the author of 4 books, 3 of which are bestsellers, and we'll get into that and how you can take a look at those books. Chris, help us understand how you got started in real estate and why this is such a passion for you these days.
Yeah, and I'll abbreviate because as I told you off air, this is going on my 34th year actually. So it's been a while. It's been a bit. My wife said to me recently, so I'm 57 now. She said when I was 50, it took you 50 years to figure this stuff out. So I'll give you the 10,000 foot view. I started in 91 building homes. I then owned a brokerage. I sold to Coldwell Banker. And then I was ramping up my own properties and coaching at that time, not investors like I do today, Tony. It was actually high grossing realtors back then. As I built up my own properties, that ran us into the crash of 2008. In my book, I call it the debacle. It was awful for me. And that caused me to do a lot of things. I mean, mentally, I was beat up. Financially, I was beat up. But what I did is I said, all right, this didn't work. And I started blaming myself. When I get out of my own head, I said, let's get some new rules here and how we're going to operate. And one was never sign personally on bank loans. That was one of our things because I get hammered by banks. And so what came out of that is, in addition to that, it was, okay, wait a minute. I've been a broker. I've been an investor. I've been a coach. That seemed to me to be pretty transactional. Do a deal, get paid, build a house, get paid, do a flip, get paid. So the other rule was, all right, I'm not doing that anymore. So we trademarked a 3 payday system to this day, and that allows people to get cash now on a deal, cash once you launch a deal, cash monthly, and then longer term cash. That's sort of like a perfect business model, but it happens to be with property. With those rules in mind, we only buy owner financing, seller financing, subject to existing financing and lease purchase. That's the only 3 ways we buy.
And you do these on what type of assets with your clients?
Yeah, this is good. So I teach, because of what I call the shiny object syndrome, I teach them to start with single families. But as I mentioned to you before the show, I mean, the building I'm standing in, I bought owner financing. It's a mixed use building on a very busy road. I have my own companies in here. So you can buy, and people do, planes, boats, cars, and any asset class in real estate with any one of those methods I just described, which is pretty cool.
So how do they find these properties? This is specific, right? You're
Yeah.
taking a section of the market where somebody could put something on MLS and, that's just open to everybody. But you're in a very specific owner financing, sub 2, lease purchase. How do you find those very specific properties?
Yeah, so for the average student, because I kept saying it's a family company, but then we coach it all across North America, right? So the average student will have plenty of leads if you do 2 or 3 things. We have one lead service that provides them for sale by owners, expired listings, they were with a realtor, didn't work for whatever reason, price, functionality, doesn't matter, and for rent by owners. Those are kind of like the 3, like a lot of investors would chat with. Now, if someone says, Chris, I got bigger goals, I'm not getting enough leads in my area on those 3 sources, I direct them to some of my favorite lists, like called niche lists, which would be free and clear properties, right? That's how I found this building. Free and clear properties, Tony, I checked this after a host said to me, well, free and clear properties must have went down when rates went down because people probably refied. So I said, well, that's interesting. So during Christmas, I checked. Free and clear properties in the United States went from like 33% to 39 point something, almost 40% of the properties are free and clear in the United States. That's a big pool to fish in that not necessarily on the market. Very, very lucrative when you can do free and clear. We can talk about why as we go.
Yeah, no, this is great. So what I want to do is maybe you can help us understand, help the audience understand what exactly is each one of these 3 categories: owner financing, sub 2, and lease purchase. What do those words mean?
Yeah, no, thank you. I go and forget that, this is new for some people. First of all, let me preface it with this. This has been around. If you pick up like the Vanderbilt book, I did because of Newport. You and I both know Newport. I'm in Newport. And it was his book, Anderson Cooper, was about the Vanderbilt. So I read it. In there, it talks about owner financing and lease purchase in the 1600s before banks. So this stuff's not new. We just kind of wrapped a system around it. With that said, owner financing is nothing more than this. I'll give you direct examples with these. So this building I'm standing in was owned free and clear. I approached the owner. The owner's goal was, why was it owner financing? People say, how do you convince him? No, his goal was owner financing. Why? Trust planning, estate planning, tax reasons. So he becomes the bank. I buy the property from him. I make monthly payments to him instead of the bank. No new money comes to the table. That's simple owner financing. So you don't go through underwriting. You don't go through a personal guarantee. You don't do any of that. We close it in about 30 days. That's unheard of with a mixed building, as you know, a mixed use building. So that's owner financing or seller financing. They're one and the same. In Canada, they call it vendor holdback or something like that. Sub two is very interesting in this market right now, Tony, very applicable. Here's why. I just hung up with a woman in Florida who was referred to me, who is not hurting financially whatsoever, but wants to sell her home and net the most she can out of it. And if she puts it on the market, she's going to pay a commission and eat up her profits. So sub two means what? If anyone's ever bought a home, subject to existing financing means on the settlement statement, when you buy a new home, a bank's involved. And on your settlement statement, it shows the bank's name and they bring that new money to the table. When you're buying home sub two, that same line exists. It just says subject to existing mortgage of, and then the amount. The deal goes, I just hung up today with her. I'm going to buy her home. I'm going to own her home, my entity, but the loan is staying in her and her husband's name until such time I cash it out in the future. Again, people say, how do you convince them to do that? I don't have to convince them. What I have to do is always listen to people and really care about what they're trying to accomplish. And if we can do that with what we're doing, it's a perfect fit. In her case, geez, Chris, I only have like 25 grand equity. By the time I get done haggling with people and then the home inspection and then the commission, I'm not going to have much left. And I said, well, I can lock in the entire 25 if you give me time. So that's how we do it. It does not go in my name. I don't assume it. I just make payments on their behalf and I own the home. That's sub two. Now, why did I say it's interesting? Now, I asked her what her rate was, Tony, this morning. She said, I don't know, but it's fixed and it's under 3%. So think about that right now.
Yeah,
You
that's
can
huge.
buy these. Crazy. So that's
Yeah,
sub two. What didn't we hit? Lease purchase.
lease purchase.
Very simple for a new person because unlike the other two, you do not take title. Let's take that same home because I could offer her the same with lease purchase. Our lease purchase agreements say that we're going to lease your home with a certain date in the future, usually 36 months, let's say, whereby we're going to get the mortgage, the underlying mortgage paid off and any equity you have, we're going to pay you at that time. So if it's her 25 grand, she would get it at the end. In the meantime, what do? I pay her underlying debt every month. I take care of any maintenance, repairs, etc. Now, how can we do that? We never do it, and we make everything contingent upon a buyer. So we never take on a home yet until we have a buyer. What are these buyers? These buyers are all rent-to-own people that need another couple of years tax return or some seasoning to show the bank because they changed jobs or after COVID started their own business. That's our typical exit. Very, very profitable with the 3 payday system I mentioned.
So lease purchase, lease to own, rent to own, those are all synonymous.
Very interchangeable, yeah.
Okay, just to help the audience, clear up any confusion there. Lease, purchase, lease to own, rent to own, all one and the same. Okay.
Yeah, what you'll hear though, this is important, you brought that up,
Yeah.
because you can go on, this is public, I'm not poo-pooing on anybody. The success rate for buyers in rent to own, if you go out and see on YouTube and a lot of educators, it's low. It's like 5 to, if they're really good, 20%, where they get the buyer to the finish line, get their credit fixed or whatever they need and get them cashed out. Our default rate is somewhere between 2 and 10% worst case scenario, because we have such a stringent, my son Nick handles it, buyer process before we'll even accept them. So this is not a glorified renter wanting to own someday and don't know if they can. This is a process that gets them mortgage ready and gets them to the successful finish line.
Okay. So this helps somebody. So sticking with the lease purchase, the rent to own, somebody's looking to exit that property sometime in the future. They don't need to exit it today, maybe because they don't want that huge tax bill. So say, for example, they were renting that home to somebody else.
Right.
So it was an investment property for them. They want to exit and go travel and do their own thing. That's very noble. And so they want to sell the building, but they don't want to sell it today because they're going to get potentially hit with a tax bill. So they decide to sell it to you in the future or sell it to one of your students, one of your clients in the future, and that client of yours pays rent. So does that help your client get into purchasing a home for themselves, or can they then go rent it out themselves? Are there any stipulations around that?
Yeah, so let me see if this answers it, make sure I'm tracking with you. Tell me if I answered it properly. So when when our family company or one of our students ties up a home under lease purchase, they could live in it, but 9 times out of 10, they're going to go out and advertise and put a rent to own buyer in that. The agreement calls for them to go ahead and do that, to put in, to sort of sublet with a rent to own buyer. Absolutely.
Perfect. Okay, so it gives that flexibility
Oh yeah.
for somebody, and especially in this market today, where we all know home prices have risen so much, but we do have the benefit of some of these homes. Some of these owners are locked in, like you said, with like a 2 point something percent mortgage rate, 3% mortgage rate. That's huge.
Yeah.
That is such a positive thing. So I appreciate this perspective that you bring, because a lot of us in real estate, myself included, I come at it from the standpoint of I want to own the asset. Like the day I close, I want to own that asset and I want a cash flow. What you do is very interesting because it brings more of the seller perspective to the table. It brings that forward in terms of solving their problem in a very different way. So what do you find is, so what's the highest success rate? Is it somebody going after owner financing or sub two or?
Okay, so some of this is what the student, and I'll tell you what we do, is like what's palatable, meaning I had a student in Chicago who, because lease purchase, our agreements are built in with $10 deposits. You can literally tie up, hundreds of thousands or millions of dollars of property with a lease purchase for $10. So he liked that. And he was a little afraid to take ownership, i.e. sub two or owner financing. So he did his first 8 deals in Chicago, Brian's his name, with a lease purchase. And then he finally got what I said day one, which was, Brian, you're going to want to own them. Sort of what you said, Tony. I like to own. I like all the benefits there. So then he switched his mentality to, I'm not doing anything unless I own it now. So it's not really what's successful, it's what they focus on and what they want to build their business around. We look at everything in our family company because we've been at it so long. So I will tell you that I would be about 40% owner financing, 40% sub two, and a small percentage of lease purchase, 20%. Ballpark in our family company.
Okay, good. That's good to know. Okay. And then in terms of real estate, so many of us love real estate because, it cash flows for us. It allows us to have renters who are actually paying the bills, the mortgage. It allows us to depreciate that property on our income tax, and it allows us to enjoy appreciation in the future when we sell that building for more than what we paid for it, right? So I think I can see how it cash flows, how it pays the mortgage through the rent that the tenant's paying, and how its capital appreciation happens. What about depreciation? Can we take depreciation when we do any one of these three?
On the sub two and owner financing, you own it. So as you know, it follows title. So yes, the disadvantage on a lease purchase is you lose the depreciation, all the other benefits, frankly, of ownership, and you're really just getting that those paydays. I call them payday 1, 2, and 3. I should have said what those are. So payday 1 is that buyer you and I talked about who needs time to get financing. They come in with a non-refundable down payment. That's your payday 1. It's your money. Payday 2 is the spread every month, like you said, almost behaving like a rental, right? You got a spread between what you're paying on the underlying debt and what they're paying you while they're getting financing. And payday 3 is really neat. So payday 3 is all of the principal pay down that accrued, like if you owned any property, and also your markup, because you get premiums on these properties. There might be a house in the market for $300,000 that sat for 9 months with a realtor. We take it and in a month sell it. Why? Because about, gosh, it's high now. It's like 83% of the population right now cannot qualify today for a loan. It's crazy in current standards. Now, all of them aren't great rent-own buyers. I'm just saying that's a big pool of who we go out and market to.
So we spoke about owner financing, we spoke about sub two, we spoke about lease purchasing or rent to own. But I want to talk a little bit about a little more about that, because I think my audience, we talk a lot about not only real estate and freedom, but also wealth. And so a lot of entrepreneurs, as well as real estate investors, listen, people who have a business, right? They may be an HVAC contractor, or they may be a CPA or an attorney or something like that. I would imagine, and give me your take on this lease purchase. I gotta imagine that would probably work well for somebody who already has a business and can then occupy that footprint in that lease purchase.
For their own use.
Yeah.
Yeah. So here, this is interesting you brought this up, because think about what we're talking about. When you learn the skill set, this can and should be, if you just learned it for yourself, it can and should be an avenue. Because my son-in-law, for example, and my daughter, when they came to work with me, they couldn't go, they weren't financeable. They just came in a new business. They left their, what they were doing. So they did a lease purchase and then they end up selling that before the term was out for like, I don't know, it's over 6 figures. So if it's a commercial contract, like you said, or resident, yes, you can and should do that. Like I said, I bought this building that way. I would never want to have gone to a bank alternatively. Yeah.
Yeah, so there's multiple benefits
Oh yeah.
of
It's a skill
of
set,
doing
like I said.
it.
Yeah.
It's very it's interesting what you do and what I do. It comes down to, people say, I'll meet him at a conference or something. They'll be like, "Oh, Tony, what should I do?" And they all want like the answer, and the answer is a very much case by case. It all depends on what your situation is. I mean, I can see if you're an entrepreneur, if you have a type of business where a lease purchase makes sense,
Yeah.
that might be the most attractive out of the three that you presented here, right? Yeah, it all depends. How
I
long does it, I'm curious from the standpoint of the coaching that you do, how long does it typically take a client to get into one of these three avenues?
Yeah, biggest questions students ask them. Go ahead. So we track as a company, unlike a lot of coaching companies, I think you'll agree. Like most people sell you something, they go, okay, who cares what happens? So because we revenue share on deals with our students, that's our model. They
Mm,
learn on the fly interactively. It's like there's no better way to learn, and it's fast because we're doing the deal with them. Now, when I gave you the days to first deal, we obsess over time to first, what we call taken, which is a deal under contract, and
yeah.
time to first sold as a company, because if we know if we can get them deals more quickly, they're not going anywhere. So right now it hovers between like 140 and 180 days. Now that we don't lop off and make it a soft number, I'm talking about people that have aggressive goals and go after it and do it in 30 days, and people that do a deal in one in a year and go, hey, I'm good with this. We factor them all in, but that's our community right now. You can say 4 to 6 months.
Okay, good to know. And then I'm curious, because I do coaching, you do coaching. So this is more for maybe me. I think the audience will maybe be reflective on the answer you give, but what is the biggest stumbling block that you find with clients?
I can tell you what bingo right off the top of my head when you said that is mismanaged expectations. Because unlike, and again, I'm not putting anyone else down that does this, but there are a lot of good marketers out there. We're not, that they're good at marketing to you on social media or whatever and getting you to buy something. And they're also good at saying with their rented Lamborghini how you can get rich tomorrow. I'm the first one to tell you it's hard. The
Yeah.
return's enormous, but it's hard. So it's mismanaged expectations. If I can catch them before they've been polluted, it's
Yeah.
easy. If I don't, and they come to the table and they say, I got to get a deal tomorrow. I'm just trying this. No, do your research for free. We have a ton of free stuff, as you probably do. Do it. Do your research. There's a lot of cool niches in real estate. They're all good. And once you do, then commit to it for 3 years with
Yeah.
blinders on. You'll have a good experience.
So this is a good segue. So do your research. Tell me about your books. You have three of your books are bestsellers. Tell me about the content you're putting out there and how people can get it.
Yeah, so Real Estate on Your Terms was done in 17 and then redone post-COVID. We happened to had the plan to do it anyway, so it was perfect timing to update it. So Real Estate on Your Terms gives you sort of everything you and I just talked about, but how we do it, A through Z, like we don't hold back. And there's students in there telling you how they did it. And then after that, we came out with the new rules of real estate, where we really we're up to, I don't know, almost 500 episodes on our podcast. But at that time, we took about 200 episodes and took like about 20 something different niches. So it wouldn't be biased to just creative. And we let that be each chapter. And then we wrote our own chapters too. So that's New Rules of Real Estate. And then there's a book called Deal Structure Overtime. On YouTube, we have, I don't know what it is, 300 or 400 deals. We literally expose deals, good, bad, and otherwise, on a whiteboard. And there are nuances though on all those deals that you can't get into in 5 minutes. Like the seller had this problem, or this is how we did this. So that book goes behind the scenes, deal structure overtime, meaning the extras behind the deals. All three of those are very practical, like in the trenches, things that we do. We'll send a couple of those out to your audience if you want me to give you that link. And they're the books, they're not electronic. We're going to send you the books right from this office. It's just wickedsmartbooks.com, / capital and the number 1, capital one.
Wicked smart
You know
books.
how to
I
say it
love it.
because you know New England.
We're we're both from New England, so we have that wicked smart accent, if folks can't tell. Uh so excellent. And so that's huge. That's huge value. And so thank you for sharing that with the audience. You're willing to ship out that content for free. Um I mean, that shows the type of person you are, the business you
Sure.
are. And so for folks who want to find you and potentially ask you some more questions about how you do this and how they get started, where can they find you? What's like either the website link or your email? What do you want to provide?
Well, the website's smartrealestatecoach.com. Shows the contact there. You can, if you want to get on the phone with me or my son or son-in-law or one of our team, just go to smartrealestatecoach.com/action. That would more be about, hey, Chris, I heard you or I heard about it, and here's where I am today, and here's where I kind of like to go. What do you think my path might be? It's just generic.
Okay, perfect. We'll definitely put that down in the show notes so folks can click on that. We'll just put the link that way.
Appreciate
It's
it.
super easy for them. But Chris, thank you so much for coming on the show today. I appreciate you. I appreciate the work you're doing to help people achieve more in their lives. So thank you so much for the content and the value that you shared today. I appreciate you.
Bet. Thank you. Appreciate being on.